Hello and welcome to Options Guide TV. My name is Brian Overby. I'm the author of The Options Playbook and your host for the next 20 minutes here on Options Guide TV. Well, if you've been following me on X.com, I went a little nutty in Micron. Micron, we put the position on. It got a little bit scary. Then it didn't get scary. Then it got a little bit scary. Then it didn't get scary. And the vol just has not came off on Micron. And I think that that's the most interesting thing in that we're still seeing short-term vols up around the 100% level. We're seeing the historical volatility around the 90 level. I don't know why this vol just disappeared on me, but that was also in the upper end of the range, close to 100 on the implied volatilities. And you can see that also right here. This option contract is trading at a 110% implied. If we run all the way back to the most at the money, we're at 110 there also. That kind of explains why this trade is looking fairly decent to me. Market has moved, though. It's gone down. I want to go back to the well. I want to trade this Micron skip strike butterfly once again. So let's take a peek on the charts. And like I said, on X.com, well, the earnings trade went off. And Micron traded very oddly, way up, way down, way up, way down. I guess we'll just show it in the charts. And we'll grab this whole little area here. But they blew away the numbers. So ultimately, we're way to the downside in this situation since that earnings report. And we've actually broken down. Well, let me go back out a little bit. And that makes it real interesting to me. Now, dang it. But this is definitely a breakdown in Micron. Oh, I'm sorry. Yeah, let's run to the Trader Pro software. I forgot to say that. But this is definitely a breakdown. And I'll zoom in a little bit here. And I'll grab this whole. I want to see this. Oh, that's Nike. But Micron, we had a breakdown. Let's go here. We had this breakdown here from this range all the way down to the 20-day moving average. And now we're sitting right on this precipice. But here's the big run up. And here's the red candle, red candle, red candle. And we're down again today. And now the trade keeps going. Doggone it. Once again, it's going against me. And that it's going away from my trade. It's now down $93. Why does that always seem to happen as soon as we start the show? It must be the 11 o'clock Eastern time hour, but we're now down 11 and we're broken below 1,040. We've broken below the 20-day moving average on the way down, right here at the 1,040 level. And don't forget, I'm going to go back to Nike. I want to talk about that breakdown too. But in this instance, below 1,040, we're talking about a 90-point move down. Now, obviously, an 8% move is a big move in any stock. But in Micron, now we're talking about we can go 100 points out of the money and still get a skip strike butterfly done for a net credit. I'm going to have to adjust the strikes because it was just $1.45 net credit. But now we're at down 90 on the day, down 8%, 1,041. I'm going to go back to the trading tab. I just had this trade on and literally it was a net credit just a minute ago of $1.45. So we should be able to adjust it. And we'll go down another 5 points here. I was focused on the 20 delta on buying that. And going 10 points wide, so you got $1,000 of risk pulling in $1.45. That's a solid trade, but the market once again just moved against me. So 122, so it's back up. It just bounced, man. It's all over the place. Now it's only down 7.4%, and this came all the way back to 120 on the mid. Let's adjust it. Let's make sure that we can get at least $1, if not more. 10% of a 10-point wide spread, and then we also have a 10-point wide long spread. So I think I like this trade better than the trade we did before earnings. There's still a lot of catalysts. There's a lot of news, obviously, big news cycle, but we really didn't see implied volatility drop precipitously in Micron after the earnings report. So we're still, the fact that it's down, we're going to take advantage of that vol, and we're going to sell a skip strike butterfly in this instance. 72. So we went back down 117. Not quite sure exactly where we could get filled. Let's move it. And I don't mind this trade. You can screenshot it or whatever. Once again, we're in the paper trading account. Not meant to be a recommendation, all those good things. But let's go in here and look at, let's scroll down. Let's do the 150 and go to the 160. Because we're still 20 delta. We're down 90. I mean, we need a more than an 8% move on the way back. And then you would skip to 170 and go to 180. And then that's going to be a $1,000 margin requirement. Man, I can't get that done for, yeah, there you go. 155 net credit. Okay. So that's where it's at, 155. I'm going to go in about 125 is where I think you can get this done. Now, it's obviously all over the place. The bid ask on this one, yeah, that's almost $1. So the extrinsic value is 1132, right in the middle of these two. So if I'm working this order, I'm going to do it for a net credit of about 125. I'm going to let it sit, and then I'm going to come back and I'm going to work the order. I'm going to do this right now in the paper trading account at $1. We'll come back and we'll review it, but I'm going to send this. And, well, let's walk through it. Okay, Micron is trading right now at $1,052.71. It's down $79.62 on the day, or about 7%. We're going to look at the very short-term expirations, the July 2nd expiration, only 3 days away. That's the expiration date right here. We're going to go out of the money. We're going to look at doing a skip strike butterfly for a net credit to the account. We're going to buy the 1,150 strike call, sell 2 of the 1,160 strikes. We'll be skipping the 1,170 strikes. So that's where our risk is going to start kicking in at expiration. And then we're going to buy the 1,180 strike call. Midpoint right now is $1 on this 1x2x1 skip strike butterfly. It's a $1 net credit to the account. There will be a 10-point margin requirement on every 1x2x1 skip strike butterfly that's executed. That'll be $1,000, but we're going to bring in a $1 net credit to the account. So let's send this down to the trading floor. Boom goes the dynamite. Order has been sent. Now, I like this trade because vol just hasn't came off, and we're seeing high. Oh, we're already filled on the trade. Wow, even in the paper trading app. Like I said, I think it's 125 is where I would work it at. But I like the fact that we only got 3 days of volatility. The market just came down. We need more than a 100-point move to get back to this level. And we have a 10-point wide skip strike butterfly. So our hedge in this is from having a long option. We own a call option at 1,150, and then we sold a call option at 1,160. So that's a long call spread. And then the second spread, we sold another 1,160 and then bought the 1,180. Okay, so this is much wider than the long spread. But on the way up, with only a few days remaining to the expiration date, by the way, Friday, the markets are closed. That's why it says 3 days here because of the 4th of July holiday. But because of that, in this instance, we can get this done for a $1 net credit, and we're heading into the holidays. It's going to be a shortened trading week. A lot of people are getting ready for it. I like this trade. I like the vols are just staying high because the stock has collapsed precipitously over the last three candles on the actual chart. So this is a very interesting trade to me. It already filled in the paper trading account at $1. I'd think I'd take $1.25. I might throw it in at $1.50 and work it from there. But if I get $1.50 with a 10-point wide risk, I really like that trade then. Let's send it to the what if calculator. you still got a lot more risk than reward. And realize that if you're doing this trade, you're doing it as an alternative to a short call spread. I don't like to think of this as an alternative to a butterfly, because I don't like to imply the fact that you are trying to make more than the net credit received. If I can make 10% on my money, $1 out of a $1,000 margin requirement, my risk doesn't kick in until I get to right here. So our total risk on this trade at expiration is $860. And that's where we're at right here, $860, which is, it came in at 140 when we moved over here. So let me put the limit price of 140 in. We executed at $1, so the total risk would be $900 to be blunt. But when we came in, it was at 140, so that's what it grabbed. And it says our worst risk is $860. And what has to happen is we have to have more than a 1 standard deviation move by Thursday on the close. And we got to blow that number away. Our risk starts to kick in on the skipped strike, which is also known as a modified butterfly, but at the 1,170 level is where our risk kicks in. So looking to make 10% over a short-term period, heading into a little bit slower trading week usually, especially with the holiday on Friday. Bond markets are closed at 2 on Thursday. The stock markets open all day on Thursday, but the bond markets close early. And then on Friday, none of the markets are open. 140, yeah, and now it's trading at a 150 net credit. Where's the stock at? It's down 71 at 1,062. Now, the risk is still here. You don't have that huge catalyst of the earnings report, but the earnings report was awesome, and the stock sold off on that earnings report. It took them a while, but eventually they started to sell off. But a lot of that has to do just with some profit taking. The stock getting a little bit overextending. If we go all the way back to the chart and we zoom back out, you see that we're getting a little bit of ways from the 200-day moving average, right? And whenever you get that situation and you get a strong earnings report, a lot of people will take that opportunity. But we broke down below the 20-day, yeah, and we're hanging right in this area. So you have all day, half a day today, Monday, all day Tuesday, all day Wednesday, and all day Thursday. All right, I heard the ting, so let's see what we have here. Go ahead. Let's look at fresh prints. Just got the 160, 170 filled for 130. Yeah, that's a solid market. So obviously a lot of people are trading very liquid. 165, 175. What did we fill? Oh, wow. So we're in the 1,150, 1,160. So you're even further out of the money. Solid. Nothing wrong with that. I like that trade. That's a solid trade. Now, it's not a home run trade. You're looking to try to make $1 and you have a risk of $9. It's the probability is very high that the market will stay below that level. And that's the actual skip strike in this instance. And thanks for sharing that, by the way, Fresh Prince. I appreciate it. Fresh Pence. There you go. That's fair. And with that mentioned, you could even go out a little bit further and you could look at the 11-day option contract and look at the balls on that. Let's see what we get when we go that far out. So 1,160, we could go quite a bit out of the money here. Let's get all the way up to the 1 standard deviation move. One of the things that, and I've mentioned this more than once, that I love about the Trader Pro software is that we highlight the 1 standard deviation move within the option chain. So you're somewhere right around here. It's usually around a 16 delta. Right now, the market's moved a little bit. It's showing it right on the 1920 delta. We're going to stay right here. So let's go 1,240 over 11 days. Let's take a quick peek and let's see if we can get 15 points wide. All right. Now this would be really nice if we got 15 points wide. We're 1,240. Let's go look at this. Hit this one twice. Oh, too many legs. Trying to make a calendar butterfly, I guess. Let's cancel that out. Let's go. Boom. Buy one of those. We're going to try going 15 points wide on the long spread. And then if we go 15 more, we're at 170. And let's go. Well, we'll try this. We'll just go at $1,000 of risk. Yeah, that's also interesting. Okay, so now this is 15 points wide, which is very important as far as time decay is concerned, because if you can get 15 points wide, then this will hold some value and this will decay a little bit more rapidly, right? So you could possibly get the stock to get up to, let's say, 1,220, and this still holds value where this decays rapidly. You're far enough away from the option that's driving it. Now, a normal skip strike, you would go to 170, then you'd go to the 1,285, but that would add $1,500 of risk. So I stopped short and I went to the 1,280. Let's send this to the what if calculator. And we're still getting it done for 110. We're still getting that dollar amount. So we don't have quite as much risk on the upside. We didn't do a standard skip strike butterfly in that we got a 15 point, come on. Okay, that we got a 15 point long spread and then a 30 point short spread, which would be double the amount of the long spread. The short spread's only 25 points. So that means 15 minus 25 means you only have 10 points of risk. So you're still going to have the $1,000 margin requirement, and we're still getting it done for close to that net credit. And then you got a 15 point wide trade here, but we got an extra 10 days. So a lot can happen over 10 days. Out of the two, I find them both interesting. But if if you want to be safer, the safer trade in my mind is to do the shorter term one. Not that I'm always going to be right, but just because of the lightened holiday, because of the holiday week trading, and the fact that this Friday the markets aren't even going to be open. So I think it's a safer trade to go at the 02 expiration 3 days away, but I do not mind the 11-day away trade because we got the same amount of risk, but we can go 15 points wide on the long call spread. Excuse me. And Kevin, good morning from Lakeland, Florida. All right, it's got to be a little bit muggy down there. I'm up in Charlotte, North Carolina. The humidity's been, messing with my hair, I have to admit. All right, overall, what do you guys think? Yeah, Micron's definitely interesting around earnings. And on X.com, we actually doubled down. So I went in and just posted a few additional trades after the earnings report, mainly because we have fundamental Fridays, and I didn't want to talk about Micron on fundamental Fridays to go along with the trade. So on Fridays, we talk about a little bit more basic things like covered call writing, cash secured put selling. And if you actually look down in the description, there's a link that will take you to an account application, and if you do fill one out, the trades that we place on all of these can be done right along with me inside a paper trading app if you want to learn along the way. But you can see everything that is in the actual platform is available in the paper trading apps within Tradier.com. So very solid offering. The market's bouncing back a little bit. Maybe that's why. I don't know. It's still $1. Oh, it just moved $1. Now it's 20-cent net credit. I would want to get at least $1 on this trade. But the market is now down 63, only 5.5% overall. Well, if you have any other questions, feel free to put them in the chat box. Fresh Pence, I'm very happy that you shared your trade with us. I think that's a very solid fill at those strike prices. I was surprised that the paper trading app filled it as quickly as it did too at $1. So very solid trade. 3 days remaining. Thursday is the expiration date after the close, and then that trade's over. That simple. If the market starts coming up, be aware that every day that goes away, it's a little bit of a schizophrenic trade in that it hurts to start. So I guess let's go back to the what if calculator. I got a couple of minutes because it hurts to start in this butterfly. Yeah, this is the one. This is, we got to, why does it keep doing that? Stay. All right. So we have high volatility, almost like an earnings report. We got a shortened trading week. This is the actual profit and loss graph right here. But every day that goes by, so if it ran to our middle strike right now, you would be down on the trade. And I'm going to highlight it right. You got to look over here. Okay. So you think about this, we're putting this on for $1. And if the stock went boom to 1,160 right now, you would be down $125 on the trade. That would be horrible. You don't want to lose, the more than the net credit received, but that's not a ton. And you don't have implied volatility that's going to spike on you or anything that's going to hurt this position. But right now, this is where it's at. Now let's add a day to it and keep your eye on the green line. So right now we have June 29th. Let's go to the 30th. Starts to flatten out a little bit. Thursday is the 2nd. Now on the 2nd, all of this comes into play, and it's 11 o'clock on the 2nd. Now at expiration, this has to go from here to there in half a day with the way the implied volatility is at. So if you can make it, if it starts trading in this range and you're down a little bit, don't fret, because 1 day's worth of time decay is huge. And then if you get to Thursday, you can ride it even. If you're not within these strikes and you're not all the way up here, if it lands right in the middle, you might put this on for a net credit. We got off $1 and take it off for a net credit as much as $10. That's the maximum right here. You can make $10. Put it on for a credit of $1 and take it off. Unwind the position for a credit of up to $10. So if I was to do this trade, the last $5 is really, you're going to get, it's really hard to get because you got all that time premium that has to come out. I always just put a good till canceled order in to sell it at least a $5 net credit. I'd be very happy with that. Put it in. I just leave that trade in. Then you also want to set alerts. You want to realize that if it gets to this strike, I want to know about it. And then I want to manage that risk in this range. But I always keep a good till canceled order in, not to close it out. I don't care if I'm going to get a dime or closing it out for a dime. I receive $1 net credit, close it out for a dime. I look at the other side of it. Anything above 5 is really hard to capture. So $5, which is half of the width of the spread, is just a good, solid, good till canceled order. Because if it does hit that and you're asleep, that might help you out. All right, that's it for this edition of Options Guy TV. We'll be back on Wednesday. And then on Friday, I'm going to put together a wheel strategy for Fundamental Friday. It will be closed, but I have a PowerPoint made, and I'm going to talk about combining the covered call and the cash secure put, and that will be the show for Friday. So thanks for stopping in, and we'll see you this Wednesday, 11 a.m. Eastern Time, for the next edition of Options Guy TV.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.